Coming up on Business Incorporated, Egypt's Ministry of Trade and Industry bans wheat exports for 3 months. Kenyans hit by rising costs of living due to geopolitical tensions. Tanzania Telecommunication Corporation and Huawei signed Memorandum of Understanding on Telecom Development. Great to have you join us on Business Incorporated. I'm Ladi Williams. First off, let's take a look at how the markets are looking on a Friday. Begin with Africa here, where we see Nigeria's NGX index dipped 0.25%, while South Africa's GSE index rose 0.47% at intraday. Elsewhere, Egypt's exchange closed on Thursday with its index in positive territory, up by 0.36%. Meanwhile, Kenya closed Thursday's session 0.04% down. And over to the Middle East, where some equities were already closed on Thursday. The Abu Dhabi exchange traded 0.14% lower, while Dubai's index edged up 0.41%. Meanwhile, Saudi Arabia and the Qatari exchanges closed trading for the week on a negative note. All right, heading on to Europe now. A much anticipated meeting of the European Central Bank took place yesterday. It's the first of major central banks to meet since the war in Ukraine began. Let's hear more now from Rob Watts right there in Berlin. Great to have you, Rob. So the European Central Bank has given its first update since the war in Ukraine began. What has the ECB said?
Well, the president of the ECB, Christine Lagarde, described the conflict as a watershed for Europe that was on course to both curb economic growth and boost inflation. Now, it's that second point that is particularly worth paying attention to, because even before Russia invaded Ukraine, inflation across the countries that use the euro was at record levels. We now know that in February it hit 5.8%, and the ECB seems to think that inflation is the bigger danger to the Eurozone. So on Thursday, it set an end date for its massive bond buying scheme set up to help economies through the pandemic, as well as its older asset purchase programme. That's all due to be over in the third quarter. The ECB is also preparing the ground for interest rates hikes aimed at bringing down inflation. Investors are preparing themselves actually for 2 rates hikes this year. That's still much fewer than the US Federal Reserve is planning, and the Bank of England has already hiked prices twice. But the European Central Bank is confident it has set a course to see inflation stabilising around its 2% target mark by the end of next year.
Well, central bankers are busy globally, but what impact is the ECB expecting the war in Ukraine to have on the Eurozone economy?
Well, Christine Lagarde said the conflict would have a material impact on economic activity, particularly because of the way it is driving up commodities prices. However, the ECB is still expecting modest growth this year. Why is that? Well, the impact of the coronavirus pandemic is now waning as economies continue to ease or completely phase out their restrictions on citizens and on businesses. The labour market is also improving, with more jobs becoming available as companies start to return to full strength. And one of the major drivers of inflation last year and the start of this year, global supply bottlenecks, is showing signs of easing. So producers and retailers are starting to slowly catch up with resurgent demand, all of which the ECB says leaves the euro in fundamentally healthy shape. Now, that assessment is, of course, very much of the moment, because we do not know what is going to happen with the war in Ukraine. We don't know how long it's going to last, how big the knock-on effect of sanctions on Russia are going to be for Europe, for example, or even whether Russia's assault might spread to other countries. So, as it has so many times over the past 2 years, that assessment from the ECB of the direction of the Eurozone economy may have to change.
Yeah, quite a hawkish stance there by the ECB. But how have markets been, reacting to the assessment of the ECB?
Well, the ECB meeting is being seen by investors as more hawkish than had been expected. Eurozone stocks reacted with surprise, really, to the early end to the bond buying schemes and higher inflation forecasts from the ECB. The DAX in Frankfurt lost 3%, as did the CAC in Paris. Meanwhile, Italy's main index lost over 4% on Thursday. That is in stark contrast to the major gains on European markets on Wednesday, which were driven by planned talks between the Russian and Ukrainian foreign ministers. Optimism surrounding that, but the lack of progress from those talks can, however, be blamed for Thursday's subsequent negative performance. Back to the ECB, the statement offered some respite to the beleaguered euro, but it's not expected to provide a lasting boost to the currency so long as the war in Ukraine does continue to rage on the Eurozone's doorstep. Today, we're seeing how European stocks react to the latest inflation figures from the United States, which showed prices are rising there at their fastest rate for 40 years now. European markets are likely to take their lead from Asia, where stocks in Hong Kong and Japan made heavy losses on Friday.
Right. All right. Thank you so much. Those were Brats right there in Berlin. Thank you so much for the update. All right, moving on to Asia now. We see shares in Asia Pacific slip today, tracking overnight losses on Wall Street as the Russia-Ukraine war continues to keep investors cautious. The Nikkei 225 Japan fell 2.05% to close at 25,162 points, shedding some of its nearly 4% gain on Thursday. The Hong Kong's Hang Seng Index, which earlier fell more than 3%, partially recovered, still closed 1.61% lower at 20,553 points. Chinese tech stocks listed in the city declined. Tencent dropped 4.47%. Alibaba slipped 5.52%. And the Hang Seng Index fell 4.28% to 4,246 points. Shanghai Composite in mainland China closed 0.41% high at 3,309 points, while the Shenzhen Component climbed 0.61% to 12,447 points. Both indexes had fallen more than 2% during the session before recovering. In South Korea, the Kospi dipped 0.71% on the day to 2,661 points. Australia's S&P ASX 200 slipped 0.94% to finish its trading day at 7,063 points, while the MSCI Broadest Index of Asia Pacific shares outside Japan fell 1.28%. And stock futures rose ahead of today's session through the Dow Jones Industrial Average looks set for its fifth losing week in a row amidst Russia's invasion of Ukraine. Futures that track the Dow Jones Industrial Average gained 156 points, while the S&P 500 futures gained 0.56%, and the NASDAQ 100 futures, tech-heavy, sat at 0.62% higher. Let's get a summary on yesterday's close from our correspondent, Maria Bird.
The U.S. stock market closed lower on Thursday as the inflation rate in the U.S. is the highest it's been in over 40 years. It is clear that the Russia-Ukraine talks that did not end in ceasefire and that yielded with little progress has a major impact on the U.S. stock market. The Dow Jones closed at 0.34% down, the S&P 500 down by 0.43%, and the NASDAQ down by 0.95%. The U.S. stock market has had a rough day as oil prices also fell today. We'll see what happens in the days and weeks to come.
That was our correspondent, Maria Bird, right there in the U.S. Moving on now, the global inflation is well on the rise now with rising costs of energy and food commodities. Recently, angry Kenyans took to social media to protest about high costs of living in the country. Let's talk to Mercy Milanoy, a business journalist right there in Kenya. Great to have you, Mercy.
Thank you so much, lady. Hope you're having a good Friday afternoon.
Yes, it's not bad. Hope yours is not bad too. But tell us, how bad is it there? With rising costs in Kenya.
Well, actually, we've been having rising cost of food commodities for the past 2, 3 years. And of course, this has been as a result of the harvest, the climate change, and also COVID. But right now, there is a major challenge right now, especially with cooking oil and wheat flour, thanks to, of course, the conflict that is going on between Russia and Ukraine, especially, and that has actually affected mostly the cooking oil because we get most of our raw materials from that side. And just to give you the clear picture of what you're dealing with, currently manufacturers here use crude palm oil, and the cost has jumped by a whopping 33%. Now, manufacturers currently buy the raw material at about 1,760 USD. That's about over 200,000 Kenyan shillings per ton. Now, this has increased during the short period of this conflict to about 1,980 US dollars, which is about 225,000 Kenyan shillings. Now, this cost wasn't this way before. This has actually doubled in the wake of the pandemic from March 2020. And initially, manufacturers were getting the raw materials, the crude palm oil, at 700 USD. So you can see the price is almost getting to a triple cost of the raw materials, meaning now the cooking oil that now we buy as consumers is almost going half the cost of our fuel that we fuel to use cars, So there's a whole debate, do you fuel your car or are you going to cook or are you going to fuel your car? And that's the case in situation. But of course, even this is even a bit worsening because Russia has imposed a 3%, has also imposed about a 3% tax on some of the products that we get from them, especially when it comes to wheat flour, because they're also trying to protect their market. And of course, this is just of the negotiations that the Kenyan government is looking at. But the cost of food in Kenya has been going up since last year. And of course, even the reason is because of inflation and COVID. But right now, especially now with the Russia-Ukraine conflict, we're backing on a lot of our raw materials from that market. And of course, this is, we're feeling the effect right now.
Right now. All right, but what's the Kenyan government saying at this point? Are you getting any sound bites from them?
Well, of course, the current people who are talking at the market players, if we look at the organizations for edible oils, who, of course, speak on behalf of manufacturers for oil. There's the Cereal Millers Association who speak on behalf of manufacturers of wheat flour and of course even maize flour, and mostly what they're saying is that there needs to now we need to be having diplomatic conversations, especially now between governments, to see how they can be able to still access the raw materials that they need to manufacture, especially cooking oil and wheat flour products. And also now the other thing is looking at regionally in Africa, where else can you be able to get these raw materials? But what the manufacturers have called upon is for the government to scrap off a 3% railway development levy that is imposed on importation of the crude palm oil that they're using to manufacture cooking oil. So once at least this is done, it will be able to cushion a bit the consumer. Of course, the price may not go down quite significantly, but at least it will help cushion the prices if we're able to take care of from the moment the raw materials gets from at the port of Mombasa here in Kenya. And if the government can scrap off the 3%, then at least this will help to manage the price of the end product. But also in the case now of wheat flour and wheat products, now it's to start banking on the current production that we have of wheat in the country, and also just look around East African commerce and other African countries, if they can be able to meet this demand, even as the government tries to kickstart conversations with Russia and other countries on where else we can source wheat flour.
Right, it's all about rising prices right now globally. All right, thank you so much, Ms. Minanoy, business journalist right there in Kenya. Thank you so much for coming on the program.
You're welcome.
All right, now we see, let's look at what's happening in the oil market now. We see oil prices continued rising, concerns about supply disruptions for Russian oil and oil products. We're on track for the biggest volatile week, with Brent crude climbing about $2.86 cents, while to $112 per barrel, while U.S. West Texas crude futures were up $2.71 to $108 a barrel. Analysts say they now forecast Brent to trade above $100 per barrel in the second quarter and around $90 a barrel by the end of the year. All right, so we'll take a break now. We'll come back. We'll drill down on Africa's fourth quarter GDP report. That's in a moment. Do stay with us. This is Business Incorporated. Welcome back. Data from Statistics South Africa shows that South Africa's gross domestic product grew by 1.2% in the fourth quarter of last year, bringing the annual growth rate for 2021 to 4.9%. Well, let's drill down on this numbers with Matt Kindiger, practice lead, Software in Africa in front of you. Great to have you on the program.
For having me on the program today.
All right, so what stood out for you, from the fourth quarter data there?
Yes, certainly. So GDP in South Africa in the fourth quarter performed slightly better than expected. And this means for the full year, we've had growth of around about 5%, which is slightly higher than we were forecasting of 4.7% in 2021. There were some interesting highlights, however. So a number of industries did quite substantially better than we were expecting. So personal services, including education and healthcare, grew by about 6%. ICT, telecoms also performed quite well. And the wholesale and retail trade industries and hospitality also showed more resilient upticks than we were expecting. However, this is in sharp contrast to very poor performance in electricity generation. So we saw electricity production fall by about 3% year on year in the fourth quarter. And this partly explains why we saw contractions in manufacturing by about 3% and construction as well. And this really runs counter to what we're seeing globally in terms of very strong manufacturing performance. And from a trade import-export perspective, South Africa has already begun to benefit from very high commodity prices. In 2021, exports grew by about 10% and 4% in Q4 in itself. But what we did see is government spending was barely unchanged in the fourth quarter of 2021. And this really reflects the fiscal pressures that the government is facing. So some positive news, some not so positive news, and overall a bit of a mixed story for the economy last year.
Yeah, quite mixed. But what's the outlook for the economy in 2022?
So after growth of about 5% last year, the economy is forecast to decelerate, and we're expecting growth of only about 1.7%, maybe 2% in 2022. There are a few things that will be driving economic growth, and this includes high commodity prices. We're already seeing increases to commodity prices, which will benefit the mining sector, in particular in South Africa. So South Africa is has a very large mining industry. The government is also prioritizing infrastructure investment, so we are expecting to see some improvements in terms of, some stimulation of the economy as a result of infrastructure investment there. But there are a number of factors that will curtail South Africa's growth potential. This includes chronic electricity shortages, which have become a lot worse over the last 6 months or so. This will curtail productivity in the manufacturing industry, which is also very important for job creation in South Africa. We also have record high unemployment, which is actually the highest rate in the world. So this will curtail consumer spending as well. And the government, although it is seeing a slight improvement in its revenues over the last 6 months or so as a result of high commodity prices, it has quite a strict policy goal of balancing its budget or removing its primary deficit by the middle of the decade. So it has very limited wiggle room to stimulate the economy. So a number of factors really will be pulling down growth potential in South Africa over the next year or so.
Right, and obviously the Ukraine conflict. How do you see it affecting the South Africa's economy this year?
So yes, it's top of mind for everyone. And at the moment, we are revising our forecasts for South Africa based on the impact of the Ukraine conflict. So it actually could substantially alter growth projections for South Africa when we look at headline growth, at least. But when we look at individual drivers of economic growth in South Africa, there are some differences that will begin to emerge as a result of the Ukraine conflict. So the sharp increase in commodity prices that we've seen globally will likely last until the end of the year, and this will have a direct benefit on South Africa. This is because not only are prices high, but South Africa also produces many of the commodities and metals that Russia produces. And so now that Russia is increasingly shut off from the global economy, demand for South African iron ore, coal, palladium, platinum is likely to skyrocket. And so the mining industry in South Africa will benefit from this, export revenues as well, and to an extent, government revenue. So we could see an uptick in government spending and exports. However, globally, we are seeing higher inflation. South African consumers will be extremely susceptible to this because unemployment is so high. Even if headline growth driven by export revenues and government spending does improve, we are expecting to see consumers really feel the brunt of higher agriculture commodities as well as higher fuel prices. So South African consumers extremely sensitive to higher fuel price inflation. So certainly a bit of a concern there. And also some of South Africa's industries, especially its automotive manufacturing industry, is quite exposed to a potential economic slowdown in Europe. So demand for exports from South Africa to Europe could be negatively affected depending on how long and how bad the Ukraine conflict becomes over the next year.
Quite interesting. And I saw today that President Cyril Ramaphosa has been called on to actually mediate between Russia and Ukraine. Are you hearing anything about that?
Yes, I mean, South Africa's position in this conflict is quite an interesting one because over the last decade, especially under the Zuma presidency, South Africa developed quite close relations with Russia. There were a number of bilateral trade agreements and quite a significant foreign direct investment between the two markets. So South Africa stands to lose quite a lot, potentially, in some respects, from deteriorating relations with Russia. So it's trying to find a middle path between maintaining relations with Russia as well as not upsetting its Western allies, especially in Europe and the US. The US and Europe represent substantial export markets for South Africa. So at the moment, South Africa is trying to walk a bit of a tightrope in terms of managing its position globally between Russia and the West. So we'll see how this develops over the next couple of months.
All right, Matt, always great to talk to you. Matt Kinniger, practice lead, Sub-Saharan Africa at Front of You. Enjoy your weekend.
Thank you. You too.
All right, so moving on now, we see Old Mutual has projected that Zimbabwe's inflation will close the year at 105%, way above what was anticipated by authorities. The central bank projected the country's annual inflation rate to end the year at between 25 and 35%. Year-on-year inflation for February was 66.1% from 60.6% in January, according to data published by the Zimbabwe National Statistics Agency. Morgan & Co. also estimated that inflation will exceed 100% in 2022. Food inflation, main driver, this rate inflation will be 105% at the year end, and that's according to Mutual Benefits. And Egypt's Ministry of Trade and Industry has banned export of wheat, beans, lentils, pasta, and all kinds of flour for the next 3 months, as the decision set to come into effect starting Friday, 11th of March. Egypt, along with the rest of the world, is witnessing an increase in the prices of oil and non-oil commodities on the heels of Russia-Ukraine war. Egypt receives 80% of its wheat imports from Russia and Ukraine. However, Prime Minister Mustafa Al-Wali said that Egypt is witnessing a smaller increase in prices compared to other countries, noting that the price of wheat in Egypt has increased by just about 17% compared to 48% in the international market. Prime Minister says Egypt's current strategic wheat reserves are sufficient to cover the coming 4 months, and is expected by its local wheat supply season that starts in mid-April to augment its total stock to cover 5 more months. And the Tanzania Telecommunication Corporation and Huawei have signed a memorandum of understanding for the deployment of fiber to the home and fixed wireless 4G services, as well as the rollout and expansion of fixed and mobile networks in rural locations. The state-owned operator Director General said the partnership is aimed at enabling both parties to work together in various areas of improvement that would help the telco build capacity at a time when the country is undergoing a digital transformation. And that's it on Business Incorporated. Thank you for watching. I'm Ladi Williams. Enjoy the weekend.